Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. Greetings, Alberto. It's fantastic to have you back on the podcast. I always look forward to speaking to you.
Thanks, Bilal. Thanks for having me.
Now, I always enjoy reading your research that you put out. And one thing I noticed in your most recent piece is how you talk about the fact that all of us focusing on central banks, inflation, cutting, lower inflation, we're all missing the point. That was last year's story. And this year there's a different story. So can you elaborate more by what you meant by that whole shift in narrative?
Generally, what we see in the market is investors have focused a lot on this giant carrot ahead of themselves. It's the carrot of rate cuts, which are going to ease financial conditions and push risk assets higher, and help the housing market, help homeowners to refinance, boost consumption, and so on. And at the beginning of the year, we had over 150 bips of cuts priced into the US front-end curve. And the same at the ECB and a little bit less in the UK. We think that's too much. Central bankers are pushing back, and it's too much for two reasons. First, because inflation is going to be more persistent. And the second reason is that the reaction function of central bankers, given a certain level of inflation, is also going to be a bit more cautious. Remember, central bankers hiked rates a little bit more slowly, and now they regret that, when inflation spiked. Why would they cut rates extremely quickly now that inflation is normalizing? And given a lot of that normalization comes from supply shocks subsiding. So we think they're going to be slow in cutting rates as well. And we think we won't see those, 6, 7 cuts that are priced in. We'll see less cuts, and we'll see them a little bit later. So a lot of the excitement in the market has been maybe a little bit overdone. There's complacency compared to 3 months ago last year in Q4, where there was widespread fear, and we said, it's time to buy credit. Now there's complacency, so it's probably time to take the foot off the pedal, but still, harvest the alpha that we see in the market. Still a lot of dispersion between good and bad names.
And the January Fed meeting that we had recently, does that, in your view, validate your view that people got too excited about Fed cuts?
When central banks push back, given there's a history of, dovish policy, the market wants to hear it, not once, but 2 or 3 times. And we are seeing continued pushback by just not just the Fed chair, but also other Fed governors and presidents. And also at the ECB level, not just from Madame Lagarde, but also other governors at the ECB, members of the Governing Council. I would say that, the market really pivoted a lot. If we look at, my former colleague at Goldman, Jan Hatzius, he went from a few cuts to a lot of cuts priced, as well as, your own Dominique, who is someone that I really value really high. She was right in forecasting a lot of Fed hikes when everyone else was dovish, but she also pivoted recently, looking at a lot of cuts. And I think, the market maybe went, and including economists that we talked to, they went a little bit too far into pricing in inflation going to target and a dovish reaction function at the same time. And here there's one piece of the puzzle that is missing, which is fiscal. Too many people look at the central banks. We don't look at fiscal policy. And there's a big change that happened in the last 5 years with Donald Trump. Fiscal policy under Donald Trump became pro-cyclical for the first time. The US government started to spend more when deficits, so when growth was already positive. And obviously with COVID in 2020 and 21, that pro-cyclical fiscal policy became even bigger. And today, we're spending in the US at a clip of 6-7% with a GDP growth that the Atlanta GDP now estimates at around 4% for Q1. So that's something that's a structural shift. Are we going to see austerity? Are we going to see a curb in the deficit? As anyone talks about austerity, no, we probably will continue to see a pro-cyclical deficit for a variety of reasons. If I want to mention just one reason, that's US elections and a likely victory, as the polls stand now, likely victory of Donald Trump, which means more fiscal stimulus and probably inflationary trade policy and a lot of other consequences for the rest of the world.
And that's fantastic. So, I mean, one of the big themes you're focusing on is politics, and you feel like people are underplaying politics when they look at macro. They're focusing a bit too much on the central bank easing cycle.
Yeah, that's right. And, it's regime change, it's politics. In our investment process, we always look at these catalysts, not just at the trend. So, the consensus for inflation is low 2% for core and headline in the US. We're forecasting above target. We're forecasting 2.5 headline, 2.7% core at the end of this year in the US. But also, we're thinking about the consequences of a likely victory of Donald Trump, what this will mean for policy and markets. It means more spending. It means onshoring. It means, domestic investment. Onshoring means that you have just in case supply chains and you have more factories producing onshore, for example, for semiconductors. It means also less funding for NATO, which probably will imply, more spending from European governments on defense. And generally, it pushes towards deglobalization and more segmentation in budgets, less connections with China, less deflation from China. So it is true that the supply shocks from COVID are coming back in, and that essentially the disruptions that we had in 2020 have normalized. But that was the easy part of the disinflation process. What we are going to witness is a global repricing of labor. A global repricing of labor, meaning that the middle class that previously, in the 70s and 80s was employed by and was outsourced by, workers in China, by workers, the blue collars and the white collar workers were outsourced. Today, we'll have to be, employed again. We have high participation, almost closing to the limit. People coming back to the workforce, very low unemployment, and non-farm payrolls is still growing, and wage growth is sticky, and so there's lack of labor force in the US and also in the UK, where Brexit aggravates the problem. And so services inflation previously was running at 2.5%, and goods inflation was running close to zero because of China. Are we going to have that in the next decade? We don't think so. And we think that the Fed fund rate floor is not 1%. It's not going to be as low. We don't like the 10-year below 4%. We think inflation is going to be at a floor of 2%. We think Fed funds will be at a higher floor than during COVID. So not near zero Fed funds, but probably, a 2 to 3% average. And then you have to add some term premium because the US is continuing to spend. So, 4% is maybe a fair value for the 10-year treasury, but it's not a buy value.
And on Trump, I can see the case, tariffs, more fiscal, less immigration and so on, that would be inflationary, and then also more antagonism with China. One difference to when Trump did get elected was he controlled Congress. Republicans had a clean sweep of Congress, so he was able to enact a lot of fiscal stimulus. Today, it's not clear whether the Republicans will capture the House and the Senate. So, do you think that's important, or do you think Trump will find other ways to, do fiscal, outside of Congress?
The fiscal trend, I would say, it's something that both parties, even if a Biden administration succeeds in being reelected, both parties will continue to spend, in our view, and it's a bit structural. It also has to do with the fact that millennials are becoming the median voter across Western democracies, and millennials were completely left out from the policies of the last 20 years. Think about the financial wealth and also real estate wealth. 85% of financial wealth and real estate wealth of that stock of wealth is in the hands of people that are older than 45 years old. So if you are a boomer, you're essentially voting for preservation of wealth. So low interest rates, low corporate taxes were the policy mix during the past 2 decades. But if you're a millennial and you're becoming the median voter now, so you're becoming the demographics that's going to decide future elections, you don't really care so much about the level of taxes. And, corporate tax rate effective in the US is 15%. It used to be much higher. The statutory obviously is 25, but when the Biden administration proposes an increase, that's just to an average level historically. So the policy mix of low interest rates and low corporate taxes, low redistribution is very conducive for asset prices, but it's not great for productivity. It's not great for investment. So if you are a millennial, what you probably want today is more investment and maybe, some sort of wealth taxes are something you don't mind. And that was the Elizabeth Warren, Democrat administration proposal. It has not been implemented. And there's also been very limited structural reforms and structural investment together with the stimulus plan, following the pandemic. But there has been some structural investment, roughly a quarter of the stimulus plan. So I would say spending will remain, and probably there's limited amounts of reduction in tax. Like tax has to be higher. So we're going slightly towards a state capitalist environment where governments have rode this way, have been riding this wave of since the 60s of let them eat credit policies, so low interest rates, growing private debt financing consumption, households essentially buying flat screen TVs and feeling happy even though real wages were essentially stagnant. We've been riding this wave of let them eat credit policy in the words of Rag Rajan, the former, RBI governor, and now
podcast guest as well. I should add.
Exactly, and I'm a fan. And so now it's time for real reform. So the economic patient has been kept on anesthetic on these kick the can policies. Levels
and one question I have in relation to that, this sort of shift in regime and people being left behind. Does that relate to why Biden isn't more popular today? Because one so-called puzzle is that the economy seems to be doing fine. Inflation's falling, unemployment rate's low, wages are picking up, but Biden's popularity is super low.
Yeah. So in other words, what's wrong with the current policies? The reason is capitalism has failed. The current combination of policies has failed to increase productivity, to increase wages, to redistribute wealth, and to redistribute opportunity. So first of all, let's think about what is a populist leader. So there's a great book on this, which is The Economics of Populism in Latin America. And it talks about the 70s and 80s in Latin American countries. It's by Dornbush and Edwards. But we can also apply to developed markets. And, what essentially says is that in history, a populist leader is someone that proposes a dream, like make America great again. Let's come back to the industrial might of the 70s. Or, for example, Brexit, and someone else would pay for it. We'll go back to the empire. So someone that appeals to a dream, someone that polarizes discontent on an enemy, and the enemy can be foreign or domestic. Domestic is usually immigrants or foreign. Think about Mexico or the European Union. But the third point is the populist leader proposes economic policies that are unsustainable and that have as an end and that are used to essentially keep the dream alive. And these policies eventually come to a halt, whether because the deficits are too high or whether because there's bottlenecks in the economy, or whether because the populist leader imposes tariffs on other countries and then the other countries retaliate. So it sounds like a very, very clear framework that we can apply to a number of governments. And what we see is that when a country is already weak, like Greece with the Syriza government, for example, a few years ago, then the populist government doesn't last very long. The bottlenecks are hit very quickly. If a country starts from a stronger point, then the populist leader has a lot of room to implement his or her policies. So what's wrong with the current policy mix? Well, it's essentially perpetuating social inequality and B, corporate monopolism. There's no redistribution. No redistribution is a halt to productivity, to growth. I mean, what is capitalism without competition? Capitalism without competition is not capitalism. There's another great book on this, which is The Myth of Capitalism. And it talks about how low interest rates and lack of antitrust have essentially, and also low taxes have essentially helped every sector in the United States to become an oligopoly, a combination of 3-4 companies that set prices, from car makers to white goods, to toothpaste, to search engines. You know, everything is very, very consolidated. And when this happens, the labor force has limited bargaining power, real wages don't grow, and large companies have a lot of means to optimize their tax rates. Now, what has policy done recently? Well, corporate taxes have remained low. Interest rates have been low, except for the last couple of years. And then when the Fed wanted to normalize and exit from quantitative easing, what they did was simply to increase the front-end rates for a year. What does that do? It only hurts the bottom 25% of the population. It only hurts people that have front-loaded maturities, credit cards, auto loans, not the large firms like Microsoft, Google, Apple, that have funded at 2% or 3% when interest rates were low and extended their maturities. It doesn't hurt jumbo mortgages, which are 20, 30, 40 years. So essentially, the Fed has never done quantitative tightening. And by only tightening the front end with a limited amount of time, that has only had an impact on people like small businesses or the poorer parts of the household spectrum that have front-end funding needs. This is actually something that we looked at in large detail into, and we said that as long as yield curves become inverted, and there's no real quantitative tightening, there's been the asset-rich households and large companies still have an advantage over small businesses. And so this creates a lopsided, very concentrated wealth distribution where the top 1% has 50% of the wealth, and reduces the amount of opportunity, reduces the amount of productivity and investment in an economy. And in the end, people are angry, I think, because of this, because capitalism.
And I suppose what's happened since COVID is that profits have gone to very high levels and real wages haven't really picked up in a meaningful sort of way. So for all the talk of fiscal, this, that, and the other, it hasn't really sort of fed through to deal with this imbalance.
Well, look, there's been an attempt to increase real wages. And in the words of Oliver Blanchard, what is inflation? Inflation is the result of a war, of a social bargaining exercise between workers and enterprises. And this is the first time where we see a change in the advantage that corporates had over labor, because there's scarcity of labor. In part, there's also migration controls in some countries, and there's also onshoring for security reasons. So it's the first time where labor is really scarce, and there's an attempt to increase real wages. I think this will continue, and this could drive inflation higher, right? And I would say that the other development here is that I think will continue is that sorry, can we cut this bit?
Yeah, sure. Yeah.
I forgot the second part of the question.
The second part of the question was,
you say real wages have been low for a while, right?
Yeah, real wages, and then you were saying that they have tried to attempt to bring real wages up. That was the point you were sort of talking about. So there's been an attempt. Before that, you talked about Blanchard, corporate versus labor.
Yeah, no, fine. No, so fine. So I think so. I thought there was another bit. Okay. No, so I think essentially there was a long period in the past where there was essentially no bargaining power for labor, for the labor force. There could be a situation where this is different. And I think this is both because of fiscal stimulus, because of the structural voting changes in the electorate, and the onshoring of production. So I would say that, perhaps the trend of, low real wages or very stagnant real wages is coming to an end. And if we think about what happened in the past, we had a situation where equities and generally corporate earnings were in a great place because we had low corporate profit, high corporate profits, low interest rates, and low labor costs, low stable labor costs. Today, what we have is a slightly different environment where we might have slightly higher labor costs and slightly higher interest rates. So it's the first time in history where we see a repricing of labor costs and also repricing of interest rates. So it's almost like, companies were in the past having monopolistic or oligopolistic price settings, low interest rates. Everything was a tailwind for shareholders. Today, there's higher labor costs, there's higher interest costs. Maybe bondholders have the upper hand. Maybe governments have more incentive to not see defaults, to not see companies fail, but also to tax excess profits and redistribute them in the economy. That's actually a better environment for bondholders than shareholders. That's the first time that the tables have turned.
Yeah. And coming back to the Fed, we've talked a bit about fiscal policy just now, and the political cycle, the election cycle this year. So the Fed, could well start to cut rates this year, maybe sometime in Q2. People are saying, if you look at markets, it could be May or June or so. So they could be cutting rates, ahead of the election, and in the election, let's say Trump wins. So you have the Fed easing into a Trump victory. I mean, is there some significance in that?
So the Fed is cutting. Why? Why is the Fed cutting? Because they can, not because they have to. It's cutting because probably interest rates are a little bit high according to the Taylor rule, but has anyone really employment? We still have high NFP, and we still have a lot of spending. And look, the surprise is that R star, so the terminal, the equilibrium rate has actually gone up. Very few people know where R star is or can estimate R star or sort of think about it. If you ask Joe the plumber, he doesn't know what R star is, but the equilibrium interest rate has probably gone up because no one in the economy is getting really hurt, except for, unfortunately, the bottom part of the population in terms of wealth. But no one is getting hurt in terms of corporates, in terms of default rates, by 5% interest rates for a year, in part because over a decade of near interest rates near zero.
Although you're just breaking up a bit there. You're just breaking. Yeah, you're just breaking up a bit for some reason. So I'm not sure if it's can you see me okay?
Let me start again.
Is it my internet connection? Am I freezing?
Yeah, I see you. You're not freezing, but sometimes my Wi-Fi.
Yeah. So sometimes you're freezing up.
Let me start again.
Yeah. I'm just thinking.
How is it? How's it now?
Yeah, now it's fine.
For me, it's completely fluid. Yeah, for me, it's completely fluid. But
yeah.
Okay. So essentially, what we were talking about.
So we talked about our stars. So you're saying we had a decade of NERP.
Yeah. So I think the surprise is that actually, when interest rates were very low, everyone assumed that the equilibrium rate was very low and that the Fed and the ECB were needed to keep interest rates at zero to push inflation up. And so there's a lot of discussion about the sustainable long-term level of interest rates. And during the QE era, when interest rates were low, then everyone assumed that interest rates, that the long-term interest rate equilibrium level would be really low, in some cases near zero. And why? Because low interest rates were not helping inflation up, were not pushing inflation up, whether in the US or in Europe. But again, the reality is the solution lies in fiscal policy, and fiscal policy was really a combination of low corporate tax cuts and relatively limited spending. And low corporate taxes or low corporate tax rates don't really help productivity. They go and benefit the top 1%. When you give an extra $1 billion to Jeff Bezos, probably he thinks of creating a better rocket to shoot himself into space. But when you give $1,000 to people that are in the bottom 20% of the household wealth spectrum, then they spend it. There's a different utility function, and this is economic policy 101. So when fiscal policy changed from being concentrated around tax cuts and low redistribution to being broader, then we have seen a stronger consumption reaction, a stronger reaction from consumers. So that's one thing that has, I think, in our opinion, brought the sustainable interest rate level higher. The other thing is that there is potentially, also more investment domestically. The onshoring means that instead of outsourcing, there could be more investment plans for semiconductor manufacturers, for example, in the US, and not just car makers. There could be more infrastructure. So more domestic spending can also lift the long-term equilibrium interest rates. And what's the conclusion? The conclusion is probably that at the next cutting cycle, we might not go as low as we're going now. Right now in 2024, we don't see a recession. We're actually a lot more worried about the scenario. The framework is, are we going to have a hard landing or a soft landing? And all economists go by the same table, same Excel table, thinking about, there's a next number of months, around 2 years after the first Fed hike, we have a recession historically. And you know what? Fiscal policy is now different. We're living in an extended economic cycle. We might have a recession, yes, but probably after elections when fiscal policy changes.
Okay. I mean, do you think there's a political element to the Fed at the moment? I mean, do you think the Fed may just cut to help Biden win the election?
Actually, I'll tell you something else. There's been a lot of discussions about that. And also Donald Trump himself has argued that if the Fed cuts heavily now, it's to help Democrats. I think that the Fed is refuting that argument, and the Fed doesn't want to cut a lot before elections because they want to preserve independence. But I think there's a financial stability argument to be made. In the US, a lot of the regional banks and some insurers have large ownership of treasuries, and in some cases, large hold to maturity books with extended duration in treasuries. And so the real rate, the interest rate level, the part of the curve that really influences risk assets is not the Fed fund rate. You can raise the Fed fund at 6% with large S&P companies being investment grade and having funded on an average maturity of 10 years. If you do that, you're actually giving them a free carry trade. You're giving a free carry trade to homeowners with a long-term mortgage. The front end by itself is not a great determinant of risk assets following a period of 20 years of very low interest rates. It's the long end. And if you see the long end going to 4.5 or 5, that's when a lot of regional banks and insurers in the middle market insurers can have a problem. That's where private equity and private debt funds in the US have a problem. That's where long-term investors start shifting from buying private equity funds or buying risky assets or buying CLOs, to buying treasuries. And we haven't seen that. So it's the long end that really matters here. in our view, for risk assets, and that's the most important thing we're watching. It depends on the Fed, it depends on expectations, and I think that's also why the Fed wanted to pivot last year, is they didn't want another banking crisis with long-end rates, continuing to stay much above 4%. And in the summer we went to 5%. So going away from its status of global guarantor of the previous world order. So we're going towards a new world order where there's a multipolar environment, where there's deglobalization, where the US will spend less on defense and will spend less to support its allies. Europe will have to boost spending on defense. And European defense projects are currently very fragmented between the UK, France, and the other parts of Europe. There will be potentially, if in case of a Trump victory, there will be potentially a deal with Ukraine. It might involve some contested territory, but it might be a quicker deal as well. So it might bring an earlier end to the conflict, even without a legal finish line, a legal solution. Some areas will remain under discussion, right? The eastern part. But generally speaking, long term, while in the near term, a Trump administration would be positive for the dollar, positive for stocks, positive for U.S. domestic growth, in the medium term, this could essentially mean, more decoupling of the U.S. from the rest of the world, more European autonomy on defense, maybe a decline in the dollar, in the use of the dollar in the medium term. So it's positive for the U.S. in the near term, but medium term, it leads towards a more multipolar world order. And we have to learn to invest in that order.
And in terms of market outlooks, then you've laid out this way of looking at the world for this year. So how are you looking at each asset class?
So here, the market has gone a long way from last year. There was a lot of fear about potential escalation of the events that happened, the tragic event that happened in the Middle East last year. And there was also a lot of fear about the supply of treasuries, the amount of fiscal spending, who would buy those treasuries. Today, we're basically at the other end of the spectrum. There's a level of complacency that we only see, every few years. The implied volatility, the VIX index is at a very low level. Credit spreads are at a very low level. And so we can quickly show in a chart that a lot of indicators here are showing complacency, right? We're essentially in an environment where credit spreads are above average, but closer to average, where implied volatility is very low. The price earnings ratio of stocks is also above average, especially for tech. So there's a bit of complacency. So what is attractive here? Well, I would say that there are some structural shifts. If you think about the typical portfolio where you have a lot of stocks, the 60-40 portfolio where you have a lot of stocks and bonds, that's something that still works, but probably is not optimal anymore in the future. And why? Because that portfolio is assuming that inflation will be stable and that stocks and bonds will be inversely correlated. So when stock prices go up, bond prices go down, and vice versa. And that's for government bonds. But if inflation remains volatile and interest rates remain volatile, then generally what happens is that these moves are more positively correlated. And so instead of having a lot of equities and a lot of credit, instead of having a lot of equities and a lot of government bonds, we think that in investment portfolios, what's missing is to have more credit, so more corporate bonds instead of government bonds, and maybe a bit more commodities, a bit more real assets that can be a real hedge against inflation in the long run. And so we like credit. We like credit because governments cannot afford high unemployment. Governments are protecting their industrial infrastructure, especially in strategic sectors. and they're spending to help firms. Governments are using the public budget to help private firms to survive. And that's true, especially in Europe. So if I'll tell you a number of companies, from Telecom Italia and Monte Paschi in Italy to Finnair, the Finnish airline, Lufthansa in Germany, Air France in France, Fnac, Accor Hotels, TUI, a holidaymaker in the UK, Burger King in France, aid between 2020 and today from their respective governments. So in other words, an environment which is more an environment of state capitalism. Corporate profits are a bit challenged by inflation and higher labor costs, and government spend to help firms is a good environment for corporate credit. And then the question is, where do you go in the realm of corporate credit? I would say the two most crowded areas where everyone has been consensus long are at the left side and the right side of this chart, where we have yields on the y-axis, and the size of each area is the size of each market. And the left side shows the safer and more senior stuff in the capital structure, which is investment grade. And the right side is the riskiest. Everyone has been long high quality credit, and investment grade spreads in the US are now just below 55 basis points, 0.5%. That's very shy of the record low, the record all-time low, which is 0.4. So just 10 bips above the record low. There's very little juice left. It's mostly a trade on interest rates. On the right side, we also see a lot of frothy characteristics. A lot of investors have been fundraising for private debt funds investing in high yield and small firms. What is the upside? In theory, you can negotiate covenants and you have more bargaining power with the borrowers, but in practice, there's so much competition, and there's a trillion in this sleeve, trillion of deployed capital, but there's over $500 billion of undeployed capital. So much competition that we see 2 or 3 funds competing to lend.
This is private debt we're talking
borrowers
about, yeah.
Whenever they need to borrow. So we think the sweet spot is in the middle, essentially, in the public market, in high yield, in loans, and in areas where you can monetize volatility rather than hide from volatility.
I mean, one question I had was, if you look at default rates, say in the US, I mean, they have started to pick up, yet spreads, say high yield spreads, haven't really, responded to that. Why do you think that is?
I will show you our last chart on default rates, if you allow me. But essentially, we do think default rates are going to go up, and they are at a very, very low level. But the question is how quickly are they going to go up? And the answer to that, the short answer is they're going up very gradually for a number of reasons. Companies have termed out their maturities. The maturity wall of debt that many people fear is actually being pushed out. And companies in the high yield market that have historically been used to, volatile and high funding costs have not really roughly conservative. They didn't engage in large scale stock buybacks. That was more of an S&P 500 activity. And so default rates have been in the range of around 2% for firms in the high yield space, both in Europe and the US. And we do think they will double roughly, going towards 3.5% in Europe and towards 4% in the US. But it's very hard to see a spike in defaults given how companies have proactively termed out their maturities. They've been able to refinance, and very little remains to be funded in the near term. And generally, earnings continue to be okay because of fiscal spending, because we don't have if we have a recession, it's a technical recession, essentially a speed bump that we had in Europe in the last quarter of last year. But we don't really have and we don't see a heavy recession coming up. So
just for context,
just
looking at your charts, when we do have a recession like the 1990, 2000.com and GFC, default rates went up above 10%. So if you're expecting a rise from 2 to 4% for the US, it's not extreme by any stretch of the imagination.
Correct. And what we have seen so far across credit sectors is that the distress and the defaults have been essentially clustered. So there are sectors that are bad and they've been under stress, but we really have not seen a distress cycle, a widespread distress cycle. There's been a lot of investors that waited for a distress cycle. They wanted to have the same entry points to buy credit as in COVID, and that's a very attractive fear scenario where all the market becomes extremely scared of defaults and credit spreads pay investors really well. But unfortunately, for investors that have waited, that hasn't happened. We don't think it will happen. We don't think we're going to have a large-scale distress scenario with a lot of opportunity. The whole spectrum. And you can see here that some sectors have been going into distress, like real estate in Europe, commercial real estate in the US, or high-yield telecoms in the US, but it's been relatively contained. It is also because central bankers have essentially sprayed foam on the runway for this potential lending, for this potential economic lending. So that the consequences of the lending are already relatively muted in the market. And again, the long end of the curve has been inverted. Companies have been able to refinance. So the pivots that Chair Powell implemented last year, communicated to markets, already has resulted in easing in financial conditions. You can see it from the Senior Loan Officer Survey that lending standards in the US are no longer as tight. They're already easing, and there is more demand, for example, and the same for Europe. And the credit spreads have gone back to near tights, especially for high quality firms. So it's a gradual default environment. This year, we have seen, since the beginning of the year, some of the companies that have paid less attention to their leverage and have, bad capital structures starting to go into stress, like Atos in France, Grifols in Spain, Intrum in Scandinavia, for example. These are 3 examples of companies that have gone into stress in Europe. But the market as a whole is very stable, and we do see some volatility going forward. We do think we're in 2024 and probably even later on. So it's a great environment for dispersion, for relative value, for capturing the volatility. Not a great environment for waiting for a extremely attractive entry point or extremely high fear entry point like COVID, because we think that policymakers are very careful about communication, and they are essentially walking the economy on this landing scenario really, really carefully. They don't want to cause volatility. And if the volatility comes, it will be in specific sectors.
And how about your view on equities and rates in general?
So as probably we have understood previously, we don't really like being long duration here. We have the 10-year just above 4%. Being long duration or long investment grade credit, which essentially is a duration call, given that the spread is only 50 basis points, is a very popular trade. There's a lot of Fed cuts priced into the front end still today. There's still a lot of Fed cuts between now and in January 2025. As the time of recording, we have still 135 basis points of cuts in the US and 125 basis points of cuts in Europe, which implies some probability of a mild recession type of cutting cycle. We don't think that's going to happen. We still have a 6-7% deficit. So we don't like front-end rates. And we also don't like the long end, where it is here at 4% in the US and bonds at 2.5%. We think that we need to go a little bit wider to price in a higher R star and also a less dovish reaction function. So both a stickier level of inflation. We see inflation for core at 2.5% and for headline 2.5% and core at 2.7% in the US at the end of this year. So it's a good level. It's a natural level to be at 4% in 10-year. If you add some term premium to that and some real rate premium, it's not an amazing level to get long unless you see a recession, and we don't. So we do see higher rates and steeper curves. For equities, we see value in a broadening of the rally. We actually think that Chinese policymakers are finally panicking and increasing stimulus, which doesn't mean that China is the trade, but potentially Europe could be an interesting trade. A lot of European exporters have been under pressure because of their China exposure, and that tail scenario of European recession and German recession because of China exposure might be actually off the cards. So we do see that equities have a bit more tailwind here. But again, we also see that higher levels of rates could create some volatility in risk assets, because when the long is thinking their allocations. So, we have okay yields in government bonds at 4 or 5%. We have relatively expensive equities in the US. Some areas of the European small cap, mid cap world are cheap. And then we have still cheap areas in credit markets outside of the US, which give you 7 to 12% yield in dollars, which is pretty attractive. And you get paid to wait, plus alpha, you get paid to wait for entry points in other asset classes, which is not bad.
That's fantastic. I mean, we've covered a lot of ground, so I mean, we could talk forever, but let's wrap up the market discussion here. Now, I do like to end all of my conversations with something about popular culture. So, I wanted to check with you, have there been any good books or TV or film that you've consumed recently?
Just 1 second, because I have one, but I want to add another one. Can I ask you the same question, by the way?
Yeah, sure. I mean, for me, there's this book from Melanie Mitchell called Artificial Intelligence, A Guide for Human Thinking. That was really, really good. It gives a very balanced view on AI, what it can and can't do. And it's a bit skeptical about AGI, given the current, developments. And then I read another book called, was it The Red Maiden's Wake, which is a sci-fi novel about a relationship between kind of like a pirate, a space pirate, and a spaceship, a sentient spaceship. It's pretty kind of far out.
What's the name? What's the second one?
It's called like Red Maiden's Wake.
Okay.
As in funeral, like wake, at a funeral. Yeah.
Okay.
Should I lead you off again? Should I ask again? And then you
I was trying to put something in the financial context. I was trying to have a non-finance recommendation and a finance recommendation. Okay. But in terms of finance recommendation, I don't have something like that came out recently.
Okay.
And last time we talked about all the books.
Yeah, we talked a lot of stuff.
Books. But sometimes, what it is that sometimes I always think.
So we've covered a lot of ground on the market side, and I do like to round off my conversations with something on the popular culture side. So have there been any good books, TV or film that you consumed recently?
It was breaking up. Sorry. So I don't know if.
Oh, should I do it again? Let me do it again.
Yeah, sorry.
Yeah.
I don't know if it's me now because I'm connected through cable. Sorry, let's just do it one last time.
Yeah, sure. So we've covered a lot. We've covered a lot of ground on the market side, and I do like to round off our conversation with something on the popular culture side. So have there been any good books, film, TV that you've consumed recently?
So while we talk about markets and the economy in the next 12 months, I would say a lot of the interesting things that we're thinking about longer term are about technology and how life will change. So a film that I would recommend that came out recently is 9 Days. And it talks about, well, you'll see it. I don't want to spoil it. And then there's another 2 older ones, which are interesting and worth maybe rethinking about. One is a film from 2013 with Joaquin Phoenix, which is called Her. And it's about AI. And it was very, very ahead of its time, potentially for being 10 years ago. And then Minority Report as well, even from earlier on. And, a lot of our thinking, besides what the market will do in the next 6-9 months, is about how life will change and about, how politics and policy will change in light of technology as well. While we think about, the next 6 months, there's bigger structural changes happening in the world.
That's fantastic. And so finally, what's the best way for people to follow your thinking?
Our investor letter, the Silver Bullet, is public. It's on our website, so www.andromedainvestors.com. And on Twitter, you can follow us. You can follow me with the Twitter or X handle microcredit.
Right. Okay. And I'll include links to that as well. And then also I'll include links to some of the charts that you referred to on this podcast. So with that, thanks a lot for the fantastic, conversation that we had, and, good luck for 2024.
Thank you for having me, and good luck with MicroHive and the great content you guys are continuing to put out. Much appreciated.
Great. Thank you.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.